Good afternoon and welcome, everyone. I'm Christina Bertinelli from VestEd, and welcome to our Lunch and Learn. Today we are here with our Chief Economist, Milton Ezrati. With the election just a week away and with recent uncertainties surrounding the markets, Milton is going to walk us through a few political scenarios and dive into what they mean for the market. Just so you know, Milton is a frequent contributor to Forbes. He's appeared on Cheddar TV, Yahoo Finance, and Fox Business, and has been quoted in lots of other top-tier media. Prior to VestEd, Milton was the chief economist for Lord Abbett and is the author of 30 Tomorrows, The Next 3 Decades of Globalization, Demographics, and How We Will Live, and Kawari. Milton, thanks so much for joining us.
It's a pleasure to be here.
For all of your viewers, we're going to save some time at the end for Q&A, but encourage everyone to drop in their questions in the Q&A section of the webinar, which is just at the bottom of your screen. And we'll be monitoring those throughout the hour, and we'll definitely save some time at the end to go through all of the different scenarios, different questions as possible. Milton, before we look ahead at possible outcomes for the election and what that means for markets, give us a lay of the land. How has the economy changed over the last 4 years? And what would you say are the major factors or events that play a role as we look forward?
Well, I would divide the last few years into 3 parts. One was the very sluggish recovery, which was well documented at the time. The other was a pickup in the economy in the last couple of years before the COVID disaster. And then, of course, the devastation that COVID, or rather the reaction to COVID, wreaked on the economy. And then the reopening, but we'll get to that in a moment. The economy coming out of the crisis of 2008, 2009 was an extremely slow recovery. It was picking up toward the end, but if you look at, say, 15 to 17, then 17 to the beginning of this year, you can see the difference in the growth rates. Now, the economy grew on average about 2.4% in real terms during those years, 15 to 17. It picked up to 2.6 on average. That doesn't seem like a lot, I realize, but it was gaining momentum as we moved into the COVID debacle. The important thing is that the unemployment rate had come down dramatically. It was about 5%, a little over 5% on average over that earlier period. It had come down to 3.7 if you want to be technical for the periods 17, 18, and 19. But it was really verging below 3.5% at the time. I think the most important distinction to this for one period to the other was the wages. During the earlier period, wages grew less than 2.5% a year. This is an hourly wage. It barely beat inflation, but they were picking up nicely toward the end in this acceleration. Wages were growing almost 3.5% a year. So the economy was picking up as we went into the COVID debacle, and we know what happened there. It wasn't the virus, actually, it was the shutdowns and the quarantines that created the problem, but it was severe. And I just, excuse me, I want to make sure I have these numbers right. The GDP, real GDP fell 5% in the first quarter and 31.4% at an annual rate in the second quarter. Consumer spending fell 7% in the first quarter and 33.2% in the second quarter. Keep in mind, the COVID wait in the first quarter was only March, so it had a tremendous effect. Investment spending fell 6.7% in the first quarter. These are at annual rates, 27.2%. Now, the COVID we know all about. We know what happened there. The economy was shut down and we had this collapse. But I think it's important to realize, looking into the future, which is the second part of your question, Christine, the important thing is that confidence was coming back into the economy as we went from that sluggish earlier period to the acceleration before the COVID mess. And I would say 2 things weighed on confidence. One was the legacy of the crisis. People were just afraid. The financial crisis was a tremendous burden on business, finance. Money did not change hands. People did not lend. And that lingered for a long time. That was a great burden in the economy. And that memory was fading as we got into the 2017, 2018 time. After all, it was 10 years from the crisis by then. The other thing that happened was a change in policy. I'm not being political here. The anti-business policies of the Obama administration effectively slowed businesses' response, not because business is being spiteful, as some people have said, but because it was afraid of losing its money to higher taxes or higher regulations. That changed after 2017, and that is not so much to choose Trump over Obama. I'm not being political here, more just the environment changed. And that too factored into confidence. And there's one other statistic I want to quote before we move on and talk about the future, or at least the present and then the future, and that is business spending. To me, this is the ultimate gauge in confidence. Business spends on new equipment, new facilities, new technology, something that's particularly important to VestEd clients. And there it was an amazing thing to me anyway. In the 2015 to 17 period, capital investment of all kinds, structures, equipment, and to intellectual capital contributed less than 0.5% to the economy's growth rate. Intellectual capital spending contributed less than 0.25% to the economy's growth rate. In the period since that period leading up to the COVID that I described, 17, 18, 19, capital spending contributed much more, 6.65% to economic growth, and intellectual capital contributed more than 1/3%. And that to me spoke to the fact that business people were more confident, more willing to put up money, and confidence is what runs the economy. So that was a big change. Then we had COVID, and now we're reopening.
Fantastic, Milton. That was really, really helpful perspective. So let's talk about COVID a bit. So do you have any insight on how this reopening has affected the economy? Was it better? Was it worse than expected, given all of the circumstances that we have going on right now? And what do you think the rest of 2020 looks like?
Well, actually, the rest of 2020 looks pretty good. Let me start off by correcting Susan Page, the journalist who moderated the vice presidential debate. She said that the reopening was not going so well. She was wrong. She should be fact-checked. Forgive me, I get annoyed at the media sometimes when they glibly report things that are simply wrong if you look at the statistics. In fact, the recovery that we've had since April, which was the lows of the lockdowns and the quarantines, and the beginning of reopening in May in various states and in various ways, we've had a remarkable response to that. In fact, we've broken records in terms of growth rates. And it's worth saying, now the economy is far from where it was in January and February. We're a long way short of the prosperity that the economy enjoyed then. But we've seen the creation in between April and September, the last month for which we have data, of over 11 million jobs in the reopening. That is a record rate of growth, more than 2 million jobs a month. The unemployment rate, which was extremely high in the lockdowns, we talked about the decline there, 14.7%. The unemployment rate is down by almost half. Now, that's not to say that it's that 7.9%, which is where it stands now, is prosperous. It isn't. It's high by historic standards, but still, that is a remarkable change. Retail sales during this period are up 33%. That is not an annual rate. That's 33% in 6 months. It's a remarkable number. Housing sales, which fell precipitously during the shutdowns, have bounced back. They are up, believe it or not, 68%. That is not an annual rate. That is the rate, 68% from April to the present. Construction of new homes up 46%. So there has been, and housing to me is an important indicator because it shows a great deal of confidence on the part of people who would buy a house. You have to have a lot of confidence to put that kind of money up. This has been a tremendous recovery, much more than anyone forecast during the worst cases in spring. Now, that doesn't mean we're back to prosperity. We're a long way. Even if this continues, it'll be the middle of 2021 before we recover the growth rates that, the state of economic prosperity that existed before COVID. But this has been a tremendous comeback from the economy. It's going to slow. It can't persist at this rate. It was a snapback from people being frustrated and wanting to get out and spend, and those who had the money did, and that created jobs, and they had money and spent it. It's the way the economy works. We're a long way from that prosperity, but there is no doubt about it. The reopening has been a tremendous success. If we get another spike and we have to close down again, all bets are off. But right now, the economy has a very good momentum going into the end of this year and 2021.
Wow, that's great. Before we kind of switch gears here, I just want to encourage everyone, you can submit questions. We are going to have time at the end of the session to ask them. Please just do so through the Q&A section at the bottom of your screen. Okay, switching gears to the election. Let's talk about possible outcomes. Would love to hear your thoughts on what the different scenarios are and what that will mean for the markets as we sit 1 week away from the US election.
Well, my guess, and I'm not being facetious, is we'll know the next president sometime in December. The groundwork has been laid. I sometimes think the American Bar Association had a hand in this, has been laid for enormous amounts of litigation. But there are three possible scenarios. One is Trump is reelected, and there we have a pretty good idea what things are. I wrote in my notes here that Trump is the most straightforward outcome, and to say Trump is the most straightforward are a series of words that usually don't get put together in a sentence, but he is. We know what we're getting with him, and I'll come back to that. With Biden, there are two scenarios because Biden has presented two faces to the electorate in this campaign. One was, I am Biden, the moderate, I am the centrist, and I will follow that kind of policy. The other is, I am Biden, the progressive. And we do not know which Biden and which policies we're going to get. Some people say his whole cabinet is going to be very progressive. Some people say, no, it's going to be moderated. I don't know. So really, there are two Biden scenarios. I'll start with Trump because that is the most straightforward. We know what we're getting from Trump. He's going to be pro-business. He's going to continue to deregulate, probably get less leverage from that than he did in the past because he has picked the low-hanging fruit, so to speak, in this particular thing. We will probably get more tax cuts. He did promise at one point to relieve Social Security taxes and Medicare taxes on low-income Americans. He said he's continuing to do that. People at the White House who are his economic advisors are working out a plan for that. That would be an additional tax cut, pro-business. The economy is going to slow from the momentum we have now, which would benefit him or Biden regardless. It's going to be, that will be in place into 2021. And we will get some slowing from that, but Trump will continue the policies that he had in place. It'll be pro-business, pro-growth, less regulation, lower taxes. The deficit won't be so good. The market will like it. The other thing that we're likely to see, Trump will lean on the Federal Reserve to keep interest rates low, although Fed Chairman Powell has promised us he'll keep rates lower for longer, and that's good for the market. So the pro-business policies coming out of the Trump administration, plus the continued low interest rates, suggest that the market can do reasonably well in this time. It will reach points where its valuations are unsustainable, but I don't think we're there yet. Biden, the moderate, is going to look a little less favorable in this respect. And we can come to Biden, the progressive, in a moment. He's going to slow walk the tax promises he has made. He said in the debate, the last debate, that he would abolish Trump's tax reform on the first day in office. Not that he can do that, Congress has to do that. But that's what he would push for. He is not, Biden the moderate is not going to do that, because the tax reform, despite its image, was actually very progressive. Of the 7 tax brackets, the ones that had the biggest reductions were the second and third tax brackets, not the high brackets, as people like to say. He doubled the standard deduction, which is what most Americans use. They don't itemize. He doubled the child tax credit. So it was a very progressive thing. Biden, whatever he says in the midst of a debate, and I realize people have to think on their feet in a debate, he is not going to attack the low end of the income distribution that way. So he will slow walk this and talk about raising taxes on the wealthy. That will have, but he will not push that too hard, because he's afraid of offending the moderate side he would be playing to if he were Biden the moderate. The market will like both things. It won't like the rise in taxes on the wealthy, or an increase in corporate taxes, which Biden has promised, but it will like the fact that he's going a lot slower than they feared. So the market could actually move up on those things. I doubt we're going to get much immigration reform from Biden. He doesn't want that. As far as regulation is concerned, he will start to re-regulate. That will please his base. But if he's the moderate Biden, he will slow walk that as well, for fear that he's going to shut things down. I think the typical example is what happened with the discussion of oil and fracking. On the one side, he's going to stop it, and on the other side, not. And as a moderate, he's going to try to bridge that gap, for at least for the near term. So those are the two options. The market would probably do better under Trump than on Biden the moderate, but it will be 6 of one, half dozen of the other in that respect.
So Milton, this was really great. So we've talked a lot about these two scenarios, but there is the third scenario, and you've kind of hinted at it in your comments here. So what happens when Biden winds up being more progressive than the majority anticipates? Can you tell us a little bit about what you think that will look like?
Well, that might not be the most fun experience for certain people, but it is the most fun stuff to talk about. The two things he will do is he will move more aggressively if he's Biden the progressive. He will move more aggressively to raise taxes on corporations and the rich, and he will implement his version of the Green New Deal. I know he's insisted that it's not the Green New Deal, but it's his version of the Green New Deal. The most important difference here, the tax increases is something the market will not like, especially if it's on the wealthy and corporations, but they have good lawyers and they will probably avoid whatever comes out of Congress. So they're not so concerned about that, and the market will reflect that. The Green New Deal, or something like it, believe it or not, is very pro-economy and pro-markets, at least in the near term. Longer term, it may have problems, but in the near term, it is an avalanche of money. So many different figures have been tossed around, $2 trillion, $4 trillion over the space of a relatively short period of time. I'm not going to venture a guess on the dollar amounts, but it is a tsunami of money. It will goose the economy. A lot of people will make a lot of money from it in terms of refitting houses and building renewables. The oil people may have to spend money on the pollution side, but there are a lot of people who will make money selling them things on the pollution side. So the economy is probably going to have the biggest boost initially from Biden the progressive. That will overwhelm a lot of the negatives, and the market will probably embrace this situation once it becomes apparent that an enormous flow of money is coming. And that, as a consequence, I think that Biden the progressive will probably give us the fastest growth in 2021, maybe into 22, and perhaps the best market in that environment than of the other two scenarios, the Biden centrist and the Trump scenario. The longer term, 2022, it becomes difficult in two ways. One is that the tax increases will not cover the cost of the Green New Deal. and not by a long shot. So the deficits will explode. They already have, largely because of COVID and the tax cuts that were put in effect in 2017. They will explode even more. People will start worrying about finances, both in Congress and in the marketplace. And I'm talking about now, 2022. The other problem is that the Green New Deal, if it is going to be effective, is, as a friend of mine said, like painting a bridge. When you finish, you go to the beginning and start again. And you can't just say we're going to make the economy energy efficient, make the United States energy efficient, and there we've done it. Because at the end of that period, whether it takes 3 years or 5 years, you start again because technology changes. And so this expense, if it's going to last, is going to be ongoing. It's going to be like an endless war from a financial point of view. Now, some people would say it's worth it. Some people say wars are worth it. But it's going to ultimately deny the economy other things and cause a lot of financial problems. But that's outside our time horizon, I'm happy to say. So if you want the best possible scenario for the markets and the economy, it is Biden the progressive, whatever the long term is.
Thank you. That was a lot. I'm sure many have questions, so please do feel free to submit them through the Q&A format. Okay, that was great on chatting a little bit about the economy and the U.S. election. I wouldn't want to lose this opportunity to chat a little bit with you about what's going on in what's the global picture, and sort of if you can kind of give us a snapshot of what you're thinking, how all of this is going to affect the global markets.
Well, there's a lot to talk about in the global.
In 5 minutes or less, please.
In 5 minutes or less, in 25 words or less. I think there are two areas to focus on. Well, one is China, and we know what to expect there. China will continue to be economically and militarily and politically aggressive. So what we're going to see, whether it's Biden president or a Trump president, is the United States continuing to press China. It really doesn't matter who, because anti-China sentiment and this suspicion of China has become one of the few bipartisan things in Congress, and indeed one of the few things that most Americans agree on. So there will be continued pressure on China. I don't think Trump will follow the same aggressive trade policy. He's effectively done his thing in that respect. But there will be endless confrontations with China about economics and ultimately military things. I think that we're going to have two other things in Asia. Well, actually, one other thing in Asia, and that is the United States setting up its alliances, military, economic, and political alliances to effectively contain China. Japan and India are the two most important players. Biden will try to do this in a multilateral way. Trump will do it in a bilateral way. That means Trump will probably get results sooner that are less profound. Biden, if he gets results in this way, because it's hard to bring everyone together, will have more profound results, but it'll take a lot longer. So that's Asia. Europe, and I don't want to belabor this, but the danger comes from Europe. Brexit has put the European Union in a difficult spot. I know they're putting a good face on it, as are the Brits. Both are suffering from this break. The Brits, in this regard, are less important. My friends in England, my apologies for that. The European Union is suffering from the Brexit, the British exit. What I think two areas are particularly significant because COVID has exaggerated them. One is the North-South divide. The South wanting the European Union to issue European Union bonds to help the poorer countries. The Germans resisting for fear, of course, that these bonds will simply become a German obligation. I understand both sides. The COVID thing, by imposing on these countries and seeing the Germans spend half the money in Europe on their own citizens to relieve the strains of COVID, is creating a tremendous push from Spain and Italy and the other countries in the southern periphery. France would is trying to act as an honest broker, but it really sympathizes with them. So that north-south divide that started with the Greek crisis in 2010 is widening. We've also had, during the COVID shutdown, the European Central Bank decided that it was going to do what it did during the financial crisis and use a lot of quantitative easing, go into the markets and buy a lot of debt to make a lot of liquidity to help people face the crisis. In May this year, the German Constitutional Court found that behavior unconstitutional for the Germans and ordered the Bundesbank to stop cooperating. The European Commission is now thinking of taking legal action against the Germans because the European Court of Justice said it was not unconstitutional. This is a big sovereignty issue, much the way the British felt about this thing. And this too is tearing the fabric of the European Union. I'm not saying they won't reach a compromise. Actually, they're working very hard on a compromise. The richer countries in Europe, they call the Frugal Four, Austria, Sweden, Germany, and Netherlands, have made a proposal to give the weaker countries in Europe some compensation, but it still has not been accepted. They'll probably reach a compromise, but the fabric of the European Union is tearing. And if I were to say a near-term danger faced our markets and global markets, it comes from Europe. And that's a happy note for the end of the global picture.
Thank you so much. That's really, really fantastic. So we have a lot of questions, and I want to make sure that we can get through all of them. And so please do keep sending them through. But I'm just going to kind of jump right in here and see where we start. So, okay, on Monday, the Dow fell over 600 points because of COVID surges. Based on what we've seen previously, do you anticipate a quick recovery? Does it matter in the long term?
Well, ultimately, the COVID we will have a vaccine, or we will have herd immunity, whatever the hell that means, and and it won't matter. But in the interim, if this spike continues to grow, and if there is a movement to start shutting down the economy or hamstringing economic activity, the market could retreat. In fact, it might retreat dramatically, as it did on Monday. It's a little. Last time I looked at the market today, it wasn't very exciting. But if we start seeing this spike and people start arguing for a reestablishment of the strictures that we had last spring, the market would retreat. I don't know if it would be a rerun of last March, but it would retreat. Then, as we deal with this thing, and particularly a vaccine is the most likely route, that retreat would become a buying opportunity. So in the long run, no, it doesn't matter, because the virus is not going to be here forever. If it is here forever, it is not going to cause people to shut down forever. But in the near term, it could be rough going for the market.
Thank you. I think it's something we all are thinking about on a daily basis. Jumping a little bit around here. So here's a question. Will the Fed keep up its expansionary policy, providing liquidity to markets and banks?
Jay Powell has said yes. In the past, the Fed changed its policy guidelines. In the past, it said that it would keep rates low, it would keep pouring liquidity into markets until the economy had reached a point where it was getting on better, and the Fed started to think about inflation. They changed the guideline. The new guidelines say that the Fed will wait for inflation before it eases up on the easing. In other words, before it starts reversing its easing, it will wait until it sees inflation, and then even then it might not act so quickly. So the answer to that question is yes. The chairman of the Fed has promised us low rates for longer.
So talking a little bit about that. So there's been a lot of talk lately about how the market's performance had never been less correlated to the economy. Do we expect a correction depending on the election outcome?
I'm sure that we're going to have some rough going with the market as the election outcome. First, there will be the tremendous uncertainty that after election day, we won't know who the president is. Maybe we'll know who won the House and the Senate, but even that might be in doubt. So that uncertainty is not going to make the market happy. And then if it's Mr. Trump, the market will probably settle down, barring some COVID concerns, probably settle down and embrace the pro-business policies I described. If it's Biden, they're going to wait to see which Joe Biden they're going to get. So I think that we're going to have some rough going with the market into the election period, and then it will depend on policy. The economy, let me just step back for a moment here. The finances of this economy, except for the federal government, corporate finances, household finances are in good shape. So barring a shock from crisis coming out of Europe or a COVID spike that causes lockdowns, there is every reason to see continued progress in the economy, almost regardless of who wins this election.
So kind of building on that, so just to quote another economist, Robert Schiller, he says that lower investor confidence and high prices are raising the risk of a market crash, saying an overwhelming majority of investors said there was a greater than 10% probability of an imminent crash. Really a remarkable indicator that people are quite worried. Are you hearing similar rumblings?
I am. I've heard that. And I think that for an investment advisor to say there's a 10% chance of a crash is to say what is an evergreen statement. Forgive me, I'm an old man, so I like old man stories. When I was a young fellow, my boss said to me, if you're Rip Van Winkle and you wake up after 20 years and before you rub the sleep out of your eyes, someone says to you, what do you think of the market? Say to them, I think it's a good bet long term, but there's a chance of a 10% correction. He said that always works, and that's always true. So that statement says nothing. What strikes me about that statement, without picking on Robert Schiller, after all, he's a Nobel laureate, and I stand in awe. If you didn't hear the sarcasm, it was there. If there were a lack of confidence, prices would not be high. A lack of confidence would drive the prices down. So people are hopeful. They expect something. And yes, is this situation uncertain? And do people think there could be trouble? That's always the case. As I explained, there's always a chance of a correction. But if people had a lack of confidence, businesses wouldn't be spending on equipment and technology. If there was a lack of confidence, prices in the market would be low. Actually, as a buyer of stocks, I'd be delighted if there was a lack of confidence. Prices would come down and it would be my buying opportunity. But the high prices contradict his assertion that there is a lack of confidence in the marketplace. So
jumping over to a different topic in the media this week.
Forgive me, I couldn't resist that.
The confirmation of our new Supreme Court judge. How do you think that this is going to have any, or do you think this is going to have any impact, long-term impact on our markets? And, the question is perhaps sort of ESG investing. How does that sit with that?
On the ESG investing, it's a fiduciary issue, and it'll be a matter of interpretation. So far, very little of that has got to the Supreme Court, so it's mostly social. I think the real risk here is if there's a victory, either a Democratic sweep in Congress or Biden wins the presidency or both, there will be a reaction to this, what is now seems to be a conservative majority, although it's hard to forecast what these people are going to do when they get to grips with a particular case. Biden mentioned today at some speech that he was thinking of having a rotation of Supreme Court justices. You'd have to change the Constitution for that. That seems unlikely. But packing the court is a possibility, and that would create a great deal of uncertainty, not so much because we wouldn't know who would be put up and which way the court would move if they packed it, but if there would be some kind of an arms race where each group packs the court when they gain the majority. And that could be very unsettling to markets and business in general. I think that's the risk here.
Interesting.
Excuse me, if they don't pack the court, it's social issues. And I don't know how that's going to turn out. It's not likely to have much economic effect.
Do you don't think that the bubbling up of the social issues will have sort of trickle down effect within sort of the markets?
And not unless they cause rioting or so, for instance, if they allow some states to limit abortion rights, and I'm not saying that's what that's going to come out of this court, that's not going to affect the market unless there's some knock-on effects that create business uncertainty.
Okay. So we have a question here. It's jumping back to some of your comments about the real estate market, and has obviously taken a toll through COVID. You know, we see people leaving the cities. We see people, you know, if you look to the Upper East Side of Manhattan, it's definitely more vacated than it was 6 months ago. Do you think that the outcome of the election will change that, especially with cities like New York City?
If Biden's elected and he changes he reestablishes the state and local tax exclusion for high tax states, high income, high tax states like New York, Illinois, California, New Jersey, that might stem some of the tide. But this is not a political issue. This is a virus issue. And it is also the fact that the virus and the response to the virus have stolen a lot of the appeal of urban living, at least for the time being. And people are saying, why am I living in a cramped apartment in a dirty place when I could live in a big house in the suburbs for less? And I'm not enjoying the city anyway. And that's not going to go away for a while. I will say this about real estate, though. If people are going to work from home in large numbers, then there's no reason to live within commuting distance either. And the suburbs might suffer, and the exurbs and the small towns might gain. Yeah. There might be a second migration away from the suburbs into, God, the small towns have been dying for 100 years. Maybe their time has come.
Well, I think you look at the window of commuting, and people never wanted to commute more than an hour, and now 3 hours is okay, because if you only have to go once or twice a week, that's fine.
That's right.
Okay, shifting gears a little, I have a question. What areas of China are growing in global competition?
Chinese technology is moving forward. The Chinese say they're ahead of us. If they were, they wouldn't need to steal our stuff. So the technology area is moving ahead. The area where China is losing is the area where it had won this competition years ago, which is the labor-intensive kinds of industries. Chinese wages have risen, and a lot of people who sourced in China because of the trade war have shifted to places like Vietnam, Indonesia, Cambodia, and Latin America. So China is losing in those areas in a big way. The other thing facing China, there are two other things facing China, so makes them a little less formidable as an economic power. And I haven't gone through all the industries in China, so I admit the technology area, a lot of people have talked about, and perhaps they have made strides, but they wouldn't be stealing our stuff if they really were ahead of us. The other thing facing China is demographics. We have a demographic problem in this country. The whole Western world has a demographic problem. Japan, in particular, has a demographic problem. I think more than a third of that population is over 65. China is moving there very rapidly, and that is going to create wage pressure in China, and it is going to hurt their economic model, which is pouring millions, billions behind a centralized function. So I think that the Chinese economy is going to have to go through a lot of adjustment here, and the kind of intense competition we've grown accustomed to from China may be dissipated around the rest of the globe. Now, I realize that's a very general answer to a very specific question, and it is my way of saying I don't know the details of Chinese industry enough to answer the question that was asked.
Got it. With rates at historic lows, what will the role of fixed income be in investors' portfolios going forward?
A place to hide. Because it doesn't pay anything. It is no way to build wealth. It used to be a way to build wealth. It is no way to build wealth. In some respects, it will have a quality like cash. Although the problem with bonds right now is the yields are so low that you get nothing from yield, and you run the risk that if yields do move up because of inflation or because of a crisis in Europe, that you will lose capital value. So it is it is less volatile than equities, but that's it. It is a place to hide is all there is. There's no way to build wealth with fixed income unless you go to junk. And then you're taking as much risk as equities.
Yeah. Do you think so? You think that as portfolios looking forward, there's just fixed income is going to be decreasing and decreasing, or do you think that cash is good right now?
Well, cash is safe, relatively safe, but it pays nothing. So you're losing to inflation, however low inflation is. You're losing to inflation even in treasury bonds, even though inflation is very low. Excuse me. There's equities. If you want income, in the past, take a person contemplating retirement, they would move into bonds to have income for retirement. They will probably gravitate toward real estate investment trusts or high dividend paying stocks rather than bonds, and withstand the volatility of stocks. Now, if they're afraid, they might leaven their portfolio with bonds to give it some stability, but there's not going to be much income there. So the idea of being in stocks when you're young and gravitating to bonds as you contemplate retirement is a less attractive scenario now. It's going to mean people will make that move, not so much to bonds, but to dividend stocks and REITs and other kind of private equity, if they can, and do so later in their working lives than in the past.
So back to the global conversation, I have another question here. What about global supply chain shifts? Do we anticipate any changes in American manufacturing after the election? And obviously, that's very dependent upon who wins this election, but what are your thoughts on that, sort of in your three scenarios, or two, or we can even just say two scenarios?
Yeah, the first two scenarios, I think the trends we've been seeing will continue. Now, there's a lot of reshoring, or whatever that's called, bringing the manufacturing back to the United States. But that is largely a function of AI and robotics. It is not, so the jobs might not be there. And we've had a boom in manufacturing jobs during the recovery, but that's really a response to the tremendous losses that occurred last spring. So I don't think there's going to be tremendous job growth there, but this bringing stuff back on shore will help, because the trade war with China and the uncertainty about China has highlighted not just China, but the dangers of having a supply chain outside the United States or outside North America. So I think that trend will continue. But it is not a jobs trend. It is, the manufacturing is coming, but the jobs won't be there. It's AI and the robotics. One of the things that is interesting to me in looking at the about this particular shift in AI is that in the financial industry, for instance, there was a tremendous offshoring of back rooms and analysis to places like India and to a lesser extent China, and that is coming home, not because we're giving the jobs to the Americans who lost them 10, 15, 20 years ago, but because this is being computerized. So a lot of the AI is actually costing jobs in these poorer countries that were a low-wage alternative at one time. Just thought I'd add that on.
I appreciate that. All right, I'm going to do a 180-degree shift here, because I have a question that I think you could probably really give an interesting opinion to, but it's not really about the election or sort of COVID. It's more about the consolidation of wealth management firms. With Morgan Stanley just acquiring Eaton Vance, what does the consolidation of wealth management firms mean for the industry at large?
The wealth management industry. Well, the wealth management industry has been investments have been squeezed from both sides for a long time. Fees are down, and the brokers and dealers who deal with them, usually who sell their stuff, unless they sell directly to the public, have been squeezing them as well. So it is still a very profitable business by the standards of most businesses, but it is becoming less and less profitable. That has made firms like Eaton Vance eager to sell themselves, and it has made it easier to consolidate in one shop. The threat to this might be from the SEC, which might say that this consolidation creates self-dealing. I have no inside information on what the SEC is thinking, but they've done this before. They have said that when broker-dealers and banks take too much investment advisory, in those days banks couldn't, but broker-dealers, that it was a danger for self-dealing, and there was actually orders given for people to divest themselves of their wealth management arms. I don't know if that's coming, but I think that is the thing that might interrupt this pattern. Otherwise, the compression on margins is going to continue, and that feeds the consolidation.
Thank you. Milton, this has been such a lovely chat, and thank you so much for answering all of our questions that really spanned all over the place. We all will eagerly be seeing what happens next week, or as you said, we'll know what happens by December, and see which one of your scenarios will end up being our reality. Thank you again for joining us.
Well, thank you. Thank you for having us into your home. I just have a screen. Thank you.
And thank you for everyone who joined and participated with some great questions. We do really appreciate it.